Hey everyone, if you're a new home buyer or if you're just confused about the different loan products that are available to us all, stick around. I'm going to go through the 7 most commonly used loan products that are out there with their pros and cons. If you're new to my videos, my name is John Cummings. I'm with Better Homes and Gardens Castledon Realty. The purpose for this channel is to strictly provide educational information to help you with your real estate needs, whether that be financial, market-based information, or anything else. I just want to help you make the best decisions you can with any of your real estate transactions. So feel free to subscribe to the content and you'll get updated with anything else that I put out there. So today's topic, we're going to talk about the most common home loan products out there, the 7 most common, and the pros and cons of each. And if you stick around to the end of the video, I want to also discuss why sellers tend to prefer different loan products over others, because they do take those into consideration and they can discriminate against which loan product they want to accept in an offer. So that is kind of important to know. So the first type of loan product available out there, and probably the most common, is the 30-year fixed mortgage. There are other terms available to us with this. You could do a 20-year fixed, you could do a 15-year fixed, you could do a 10-year fixed. But the most common is the 30-year fixed. And what's the biggest pro with this? Is the fixed interest rate and the known payments. Your interest rate will never change, your payment will never change for the 30 years. That is great stability to have and to know as you're going into making a very large purchase. The main con with the 30-year fixed is that you tend to get a higher rate than with a shorter term loan. And the reason for that is basically the bank is stretching out this loan 30 years, which basically increases their risk that they won't get their money. So they then charge you a higher interest rate. So you're going to pay more over the life of this loan than you would with a shorter term loan. But like I said, you could go with a 20-year or a 15-year fixed rate. But again, the rates are going to be a little bit higher than if you went with a 5-year term or anything like that. So those are the main cons with the 30-year fixed, but this is the most commonly used. Then the second one is the adjustable rate mortgages, or ARMs, as a lot of people call them. And there's a lot of terms available for these. It can be 10 years, 20 years, 15 years. There's a lot of different options available as well, as far as the rates and how they move. But it's just as it sounds. It is adjustable. It's an adjustable rate mortgage. And the pros to this are you initially get this teaser rate, or a lower rate than you would with maybe the 30-year conventional loans. Um, and that's, like I said, they call this a teaser rate to kind of get you interested in it. But the cons for this type of loan is that the payments are not steady and they will change over time, and that period could be monthly, it could be quarterly, it could be yearly, every 3 years, 5 years. Again, it kind of depends on the loan product you're using and the lender that you're working with. And the way that it adjusts is based on an index that the lender uses, and this could be a number of different indexes that they use. But again, you'd have to discuss this with your lender. But main takeaway is that this will adjust. But the pro is that you could get an initial lower rate if your exit is maybe a quicker exit than the 30-year. So moving on to the third most commonly used, and I wouldn't really say it's a very common used one, but mainly for investors, they look at interest only mortgages. And it's really not recommended for most borrowers. If you're just a typical home buyer, you're not even really going to consider this. And it's more for short-term exit strategies with investors. But the pros to it is, you're just paying the interest on this mortgage. So you're paying no principal at all. So your monthly payments are, much lower. But the initial term can vary on how long this is. And once you reach that term, which we come to our con, is you either have a steep increase in your payments because now your principal is coming back in and your interest rate is likely changing, um, or you may be coming up on a balloon payment, as they call it. So what that means is you're paying your interest, maybe let's say for 5 years, and at the end of that 5 year term, you need to pay off the rest of that loan, or you need to refinance, or you need to do something else. So that's the main con to that is, you're going to have a steep increase in your payments or need to pay off the entire loan at the end of that term. But it's good for short term, um, investment strategies. Flippers use this, as a quick way to make their flip, and then they either refinance or sell the property. Um, Now, I know I'm focusing a lot about the interest rates here, and how they could change or adjust, or how they stay the same, and those are the main differences with these products. But you have to know that these interest rates change a lot due to what the Federal Reserve is doing, or the Fed. Um, and if you'd like to learn more about the Fed and how they operate and how they affect our everyday lives, feel free to check out my other video on the Fed. It has some good information that you may want to know, and I'll put that in the description below. Now, going back to our loans, we have our number 4 is a jumbo loan. So jumbo loan is basically it's like a conventional loan, except that a home value exceeds a certain amount that conventional lenders don't want to go to. And right now, that amount is $726,000, and that's up from $647,000 in 2022. So if you have a home value that's $726,000, you're likely not going to be able to use a conventional 30-year fixed mortgage. You'll need to use a jumbo loan. Now, these jumbo loans, like I said, they're pretty similar to conventional, 30-year fixed. They have competitive fixed rates, and they help you to buy, a fairly expensive property, which is the main pro. Now, the cons to this is you really need to have a higher credit score with this, 680 or greater, and you may need 12 months reserves of your mortgage payments in order to obtain the loan. This also comes with higher closing costs, and fees involved with processing the loan. But it's very comparable to the 30-year fixed, just for a higher amount. Moving on to our government-backed loans, the FHA loans. This is insured by the Federal Housing Administration, and the pros to this is you only need a 3.5% down payment, and with a 580 credit score. If you have lower than a 580, you may need up to 10%, but much lower than the traditional 20% down. The cons to an FHA loan is there's more requirements to get the loan. To get to the closing table, you have your appraisals, inspections, that you are required to do and meet the requirements of the lender and the loan. And you also are going to have mortgage insurance for the entire term of the loan. It's not like PMI insurance, if you have less than 20%, which goes away once you reach that. This is for the entire length of the loan. So moving on to number 6 is our VA loans. And the VA loans, it's insured by the Federal Housing Administration as well. I'm sorry, the VA loan is, these are all private loans, but again, it's for just vets. And the pros to this are there's no down payment required, there's no mortgage insurance, and there's much lower closing costs. So it's a really great loan product if you're a vet. It provides you a really good opportunity to buy a house. The cons to this are, again, there's more requirements to get to that closing table, appraisals, inspections, and you also need to pay a funding fee, which ranges between 1.4% and 3.6% of the borrowing amount. And it kind of gets a negative stigma from sellers, these VA loans, and it's not really that much different than an FHA loan, but it does get a negative stigma. And the main reason for that is because the VA loan allows you to have all of the closing costs paid by the seller. It doesn't require them to do that, but it gives you that option. And sellers don't typically like that, and it kind of just gives that negative stigma. Also, a con to this, the VA loan, is you cannot buy investment properties with the VA loan. It's got to be your primary residency. Now, going on to our final one is the USDA loan, which is backed by the U.S. Department of Agriculture. And again, this is, the pros to this are no down payment, no mortgage insurance, I have lower closing costs. But going to the cons, it's geographically, restricted to rural areas that need to be, qualified. You need a higher credit score, which is 640 or higher, in order to obtain this loan. And there are also income limits to this. So depending on your area, in Pennsylvania, your household income can exceed $103,500, which is up from $91,900 in 2022. And again, this isn't for investment properties. So those are the 7 most common types of loans that are used. And now that we've gone through the most common types, I'd like to talk about why sellers like certain loan types over others. And it all comes down to, what's going to provide the least amount of headaches for the seller and get to that closing table and finish the transaction. So, because really, after all, whatever loan product you're using, if you get to that closing table, the seller is going to get their money either way. But what's going to get them there, with the least amount of effort, and make sure that transaction closes. Now, the easiest route is cash. So a cash offer, as we've seen a lot in the past 2 years, is the most attractive to a seller. And why is this? Because there's no bank involved. There's no other party involved to create any sort of requirements or meet anything else to close that transaction. Once the seller and the buyer agree, and they put the contract in at cash, it's almost as good as done. The next, most preferred loan type would be, a conventional 30-year fixed, 20-year fixed, 15-year fixed, or, I'm going to throw in jumbo loans with this as well, because, they're in the same kind of category. And why would they prefer these conventional, 30-year fixed loans or jumbo loans over a VA, FHA, or USDA? Well, again, it all comes back to, what's going to get us to that closing table with the least amount of work, and what's, the best, option to get us there quickly. And on the front end, buyers need to jump through more hoops to qualify for those jumbo loans, for those conventional loans. You typically need a higher credit score. You need, your down payment money. So the buyers they have some skin in the game at this point. And, the sellers recognize this as, you're more of a serious buyer, and you're going to work to to close this transaction, while you go to a VA loan or an FHA loan or USDA loan, where you may not even need a down payment, and you also need to meet all of the requirements as far as the inspections, the appraisals, and you have to get all those with those loans. And if something pops up that doesn't pass the inspection, or it doesn't appraise, then the whole transaction could fall apart, and the seller has to start all over again. So that's the main reasons why sellers prefer those conventional loans over the FHAs or the VA loans. But of course, cash is king in this scenario, and is your strongest option if you're going to be putting in an offer. And again, sellers can discriminate based on the loan products that you are using. So keep that in mind, that this does play a factor into your offer when you're submitting it. So those are the most common loan products, their pros, cons, and the thoughts about why sellers prefer specific loans over others. If you like the content, feel free to subscribe, and I will see you guys again in the next video. Thanks.